Try to visualize this situation. On Sunday night, financial Twitter or FinTwit was going crazy. Everyone was speculating about the major changes that were going to come in the options trading market and how retail traders might be affected by quite a lot. Because on Monday, there was a major SEBI board meeting and then Monday rolls in. You know how a lot of people here at MarketFeed, we're all traders. So the entire discussion in office for Monday was about the SEBI's new major announcement that will come out. And nothing happened. We ended up scrolling the newspaper websites even at 10:30 p.m. in the night. But other than few new proposals regarding mutual fund light and a new asset class, there was nothing about futures and options trading. You can imagine what the situation was like. So all of us here at MarketFeed, we are all relieved. We go out, it's Bangalore, we have fun. And then Tuesday comes into the picture. So Tuesday also, the first half, nothing drops. But at 6:30 p.m. in the evening, SEBI comes out with an announcement saying that all their major points in the consultation paper from last month have been implemented. And yes, as always, we wanted to make a very practical and easy to understand video out of all of this. And so we thought we'll take some time and we formulated all our thoughts into this video right here. So in this video, first we'll discuss about what all are the major points that you should be noting about from this major announcement regarding options trading. Then we'll go into our thoughts and opinions on what we think the advantages are and what we think the disadvantages are. So that's the agenda for today's video. This is Ajay Ajith. Welcome to MarketFeed. So yes, this is the official SEBI circular that we were talking about. So last month, SEBI had come out with a consultation paper asking people or the general public feedback on what they think of these proposed measures, right? And we, yes, MarketFeed had also sent in our suggestions as well. But yes, it is out here finally. Let's go through each of the points one by one in our simple PPT we have made for you. So if you have not watched that previous video, let's quickly go into the why. Why did SEBI come out with such a circular? They said that they want to help improve market liquidity and allow investors to better manage their risks. That is a why of SEBI. So they are doing this by trying to control two things in general. So one, they're trying to do is to control high inflow of retail money into index options, and two, hyperactivity around expiry days leading to volatility. So this is what they wanted to control. And yes, let's discuss all the points here one by one. So 6 new changes have been announced. Contract size for index derivatives, rationalization of weekly index derivatives products, upfront collection of option premium from buyers, increase in tail risk coverage on the day of options expiry, intraday monitoring of position limits, and yes, removal of calendar spread treatment on the expiry day. So 6 new changes have been announced. These are all the changes, and out of this, I feel that the first 2 will be the most impactful. So we'll go through them in detail, then we'll quickly go through the next 4 ones in this video. So first, let's discuss point number 1, which is contract size for index derivatives. And make sure you watch this part very, very closely. Be it an option seller, be it an option buyer, everyone is going to be affected by this point. So let's go ahead and try to understand it. So this point says that there is a new contract size requirement from SEBI side. So currently, all index options have a contract size between 5 and 10 lakhs, and it is going to be updated to between 15 and 20 lakhs. So what is this contract size and how do you find it today? So today, the contract size of Nifty can be easily found out by multiplying the current market price of Nifty, which is around 25,000, let's assume, multiplying it by the lot size. So today, Nifty's contract size is 6.25 lakhs, and that needs to be increased to somewhere between 15 and 20 lakhs. So what do you think is going to happen? Can Nifty's value change here? No. Nifty's lot size is going to be updated. So Nifty's new lot size could be somewhere between 65 and 80. That will mean it falls under this 15 to 20 lakh range. So what is essentially happening here? The entry barrier to either buying an option or even selling an option contract has been increased. So let's say you are someone who was buying a 25 rupee premium Nifty option earlier. So earlier you need to pay 25 into 25, 625 rupees to enter that contract as a buyer. And today you'll need to pay somewhere between 1,625. So you saw how much increase that is. So from 625 rupees, you went up directly to 1,625 rupees just to buy that option. On the option seller side, similarly, margin is going to increase. Just for easy calculation of margins, you can say that it will be 3 times of what the current margin requirement is. So if your iron condor today is taking up a margin of 50,000 rupees, it is going to be 1.5 lakh rupees to enter that same iron condor. The profits or the ROI that you could be making, they're not changing. It is just that the entry barrier has been pushed higher. So there are a lot of advantages as well as disadvantages to this. Let's get to that towards the end of the video. But for now, I hope you understood this point very, very easily. So the margin required both for option buyers as well as sellers is going to be tripled. Now if that is done, let's get to the second bombshell announcement, which is rationalization of weekly index derivatives products. So SEBI saw that a lot of speculation was happening due to these weekly expiries and multiple weekly expiries. So what they said is that the current situation says that each exchange, NSE and BSE, have multiple expiries resulting in almost everyday expiry from Monday to Friday. There is some or the other index having a weekly expiry. So what is the new rule here from SEBI? They have said that each exchange may provide derivative contracts for only one of its benchmark index with weekly expiry. So rest in peace, Nifty or Bank Nifty. And there is no going around the fact here, either Nifty or Bank Nifty is going to be no more from the date SEBI has said, which is November 20. So yes, monthly expiries can still continue, but each exchange can only have one benchmark index for its weekly expiry. That is a change here. So if that is clear, let's move ahead quickly into the next 4 points. We'll quickly glaze through them and get to our thoughts and opinions. So the third point is upfront collection of option premium from buyers. So here, what is the current situation? There are some brokers, mostly if you're using a discount broker, this won't even affect you. There are some brokers that allow retail traders to take leverage positions using cover orders. So I'll quickly give you an example here. Let's say you're going to buy an option worth 100 rupees and the lot size is today 25. So 100 into 25, 2,500 is the premium payable. But some brokers allow you to circumvent this rule using the cover order format. So let's say you have a cover order with a stop loss at 90. What is your spread there? Your max loss is only 10 points. So some brokers only charge you that 10 rupee max loss multiplied by the number of lots. 10 into 25, which is 250 rupees as premium. Now that is very obviously not a good thing, and that is what SEBI is trying to control. Full upfront margin should be collected without offering any leverage. So that mostly is not going to affect any of you. So fourth point, increase in tail risk coverage on the day of options expiry. So as we told earlier, SEBI wants to control all the unwanted speculation that is happening on the expiry day. So they have decided to implement something which is called as an extreme loss margin. Again, it was already there. They're going to increase it on expiry days. So if you are an option seller on expiry day, there is an additional 2% margin which the exchange will be asking from you. So if earlier your trades could have been placed with 10 lakh rupees, today or going ahead, you'll need to put up 10.2 lakh as margin to make sure that your trades go smoothly. Now that is also okay. I don't think it satisfies the original why of SEBI, but let's go ahead and move into the next point, which is intraday monitoring of position limits. So currently SEBI's position limits for index derivatives are monitored by stock exchanges at the end of the day. But the new rule says that there will be 4 new windows, right? 4 new random snapshots being taken to make sure that brokers are adhering to this intraday monitoring of position limits. Now, this could be a big problem, but at least the implementation date is towards April. So there is a lot of time for brokers to test it out, see if it is actually happening, and then to take a decision from it. So to summarize this, today brokers have certain limits imposed on them by SEBI, which says that they cannot have more than X percentage of the total OI in the market, but it is being monitored only at the end of the day. Now, there will be a new intraday monitoring system coming in where even at different points through the day, they should not be breaking this market-wide position limit. So while you are trying to enter a trade, a broker could go above this limit and you might not be allowed to enter that trade during the day. Imagine what a disastrous situation that could be, but at least we are having more time for its implementation. So let's go ahead into the 6th point. So yes, the 6th point, which is removal of calendar spread treatment on expiry day. Just like the extreme loss margin and a few of the previous rules, I believe this is trying to limit certain good traders, at least good calendar traders. So just to give you an understanding, on expiry days, there will no longer be any calendar spread margin benefit for traders. That is what this entire point says. So it is still a bit confusing here, and that is why they have again given time for this implementation. This point will be implemented only by February 1st of 2025. So then let's go into the implementation dates of all of these points, right? So as you can see, the major first 2 points, which is contract size for index derivatives going up, as well as reduction in number of weekly expiries, they're both going to come in effect from November 20 itself. That is just 2 months from now. Either Nifty or Bank Nifty weekly index options will no longer exist. The fourth point, which was the extreme loss margin on options expiry day, that will also come into effect from November 20. So make sure you have a snapshot of these dates. So then let's get to the most important part of the video, which is our thoughts and opinions. So let's start with the negatives here. So we think that the increased margin requirements could make retailers look to other betting instruments where the entry barrier is less. So stuff like Dream11 and other fantasy gaming apps, that is where this money could flow to. So all the gamblers in the house, you will still try to gamble away money in the market. That is the unfortunate truth of it, right? All the retailers could start flocking to these other betting instruments. And then that is just about betting. But people will also start to consider moving into forex trading, crypto trading, and all of that due to the high leverage being offered, even though it is illegal and has its own challenges. So that is also an unfortunate negative of this entire situation. And also, due to the increase in margin requirements, option buyers will go even more far OTM, where probability of winning is even lesser. So what does that mean? So let's say today you're buying an at the money option where the margin required could be somewhere between 5,000 and 10,000, and now the margin requirement is much higher. You could start gambling or start trading in far out of the money options, and all those people who does that, they'll end up having a lower probability of winning because it's a far OTM strike that you're going to buy. So that is the reality of it. So then let's get to the positives. So I fully agree with SEBI's advice, but the implementation part of it is the only question here. But I think even with this steps that they're taking, there are some positives. So the first positive that I hope to see is volumes will increase in equity cash segment, and this can help reduce market volatility and index manipulation. So the markets have been going crazy, guys. There is no way around it. All the expiry day moves that could change, and the market could take a turn for the better. So that is a positive that could come out. Then hero zero speculation could decrease. That is also a good thing, I would say, because I saw this phenomenon of huge live trading YouTube events where more than 1 lakh people are watching live, and their entire title is Hero Zero Trading Opportunities. So all of that, hopefully the market will get calmer and all of that will go away. And third, there could be reduced volatility in premiums as well, and more natural price movements in the indices could come out. That is a third positive side of things that I see happening. So all this manipulation, it could reduce, and the natural movement of both indices as well as premiums could happen. We required only 5,000 rupees to sell a lot of options in Nifty or Bank Nifty. That was the situation. But after that, we saw that all the stuffs, including higher margin requirements, no leverage for options, all of this kicking in, but still the market survived. So again, even though it is an uncertainty, we believe that the market might not be affected by these liquidity concerns. And the only question out there now is Nifty or Bank Nifty going to be the one to stay? And will BSE working together with the NSE? Will they keep Sensex or BankX? So that's it for the video, guys. I've discussed all the points in detail. We've also talked about our thoughts and opinions on this entire move by SEBI, and also how will this affect market feed as well. So do stay tuned. If there are any updates, we'll be posting them on this YouTube channel. So get subscribed. And if you like the video, make sure to hit the like button and let us know all of your thoughts in the comment section down below. This is Ajay Ajith signing off. See you all again in another practical finance and stock market video. Bye bye.